Hello, everybody. I'm Maurice Kempner. I'm an attorney, a real estate broker, business consultant, and coach. Welcome to True Legacy Wealth Media. So, today I'm going to talk about how, with real estate, you can live tax free if you wanted to. If you set yourself up and you structured everything in such a way to do that, you could do that if you wanted to. Now, it always comes down to the bottom line if that's the most profitable thing to do with the opportunities you have available. But let's just say it is. There is a way to do that so you don't have to pay any taxes on your income. It's what I like to call sweet spot investing when it comes to real estate, right? So here's how this works. So let's say you got a house. So let's just say this is $100,000 of real estate investing. This is how this is broken down per 100,000, right? So maybe the property's 200 or 300 or 350 or whatever. I'm just showing you per 100,000 how this principle works, right? So here you have this house or portion of real estate, it's $100,000. Now, of that $100,000 purchase price when you go to buy it, part of it goes to the land and part of it is the purchase of the building itself. So the land underneath it is worth a certain amount. The government will not let you depreciate the land because the land never wears out. Okay, so let's say in this case the land is worth $15,000. Then let's say the building, the house on top of it, is worth $85,000. That means you can depreciate the $85,000 value of that building over time. Now, for residential real estate, it's 27 and a half years, right? And that's what I'm talking about here. For commercial, it's 39 years, but we're talking about residential here. So you've got $85,000 of building value when you purchase that property. You depreciate it over 27 and a half years. That means you deduct it over 27 and a half years. That comes out to $3,090 a year that you can take as a deduction from purchasing that property. When you have this rental income from your rental property for the year and you file your taxes, on there you're going to put down all the costs you had for the year. So you can put all your insurance costs, your maintenance costs, your property taxes, repairs, all that stuff, property management, everything else. You put it on there. Now, to deduct those things, so you have to actually spend the amount of money that you're deducting. With depreciation, however, that's just not the case. So what happens there is you can deduct this $3,000 a year on that rental property, that $100,000 rental property, as a business expense because they're letting you deduct the cost of the building because it wears out over time. That's the theory. And so they let you take a little bit at a time. So now you write this off every year. So that means if you have, after these other expenses that we talked about, a positive cash flow of around $3,000 a year and a depreciation tax deduction of around $3,000 per year, you're not going to pay any income taxes on that $3,000 positive cash flow, right? So this is how this works. So you build up your inventory, you get a lot of rental properties, and you are the average of all this stuff with all these properties is in what I call the sweet spot where the depreciation deduction will cover all or most of it. You're just not going to pay any or very little income taxes, right? Because depreciation is just going to cover the depreciation deduction. It's just going to cover it all, and you're not going to pay any income taxes. Now, because it's tax free, that's great. That's very attractive. But the bottom line is still the bottom line. Just keep that in mind. So you look at all your opportunities and see if tax free income from real estate is a good bottom line for you. And in most cases, it's really good. Because there's a lot of other tax free parts to this too. There's tax free growth in the appreciation that the property goes up in value. That there's ways to never pay taxes on that. And then there's the paying down of the mortgage on the property by the tenant. And so that increases, that gives you more equity and value in the property, and you never pay taxes on that. So you have tax free cash flow, appreciation, and amortization is on the loan, is the bottom line here. And that's how it's done, right? And there's ways to do it to make sure it happens correctly. It's probably a good idea to talk to somebody that knows a little bit about this and can give you more details about it. And then a lot of it depends on the individual properties you get, and the taxes and cash flow are not the only considerations that you're going to have when you buy real estate, just so you know. But it's really great if you can live tax free, and it boosts your overall income in your pocket at the end of the day by doing that, which is what I'm talking about. And this is how this works.